Hey everyone, welcome back. If you're new here, I'm Mariangela with Calgary's Finest here at RE/MAX First, and every single month I sit down and break down exactly what is happening in Calgary's real estate market. Not just the numbers, but what those numbers actually mean for you as a buyer, a seller, or someone who is just watching and trying to figure out when to make your move. And I have to say, it's been so nice to hear from so many of you lately, regular watchers who are reaching out and telling me that they're ready to make a move or ready to start exploring what that looks like. I look forward to meeting many more of you. Now let's get into it because May had a lot going on. Let's start with the Calgary real estate numbers for May, because this is where I want to spend some real time, and the data tells a story that I think lots of people are misreading right now. Calgary sales in May came in at 2,162 units. That's down 16% year over year. New listings came in at 4,226, down 12.7% year over year. Inventory hit 6,752 units, which is essentially flat year over year, up just 0.1%, but still 11% above long-term trends for this time of the year, driven mostly by the apartment and townhouse supply. The sales to new listing ratio landed at 51%, which is right at the threshold of balanced market territory. And months of supply are sitting at 3.12, up 18.5% year over year, but still within balanced market range overall. Now, here's what I want you to understand about those numbers. And this is where I think a lot of the media coverage gets it wrong. A balanced market is not a bad market. It's not a crashing market. What it is a market where buyers have options, sellers have competition, and pricing actually matters. And I want to break this down by property type because this is not one market. It hasn't been for a long time. It's several very different markets happening simultaneously right now in Calgary, and treating them all the same would be a mistake. I would much rather live in a balanced market than one that is sitting at either extreme, because if we are in a hot seller's market for a prolonged period of time, the devastation we're watching unfold in Toronto and Vancouver is something that I do not wish for this city. Families priced out for life, generational wealth locked behind a door most people can't open, and on the flip side, a deep buyer's market for too long has its own very, very harsh detrimental damages. It hits everyday Calgary families. It erodes equity, especially in people that need it most. It slows investment. Balance is actually the goal. And right now, that is broadly where we are here in Calgary. This is a good thing. If this is the type of content you've been looking for, please show your support and don't forget to like, share, and subscribe. Let's start with detached homes because this is where the strongest part of the market is right now. The detached benchmark price in May was $747,800, down 2% year over year. But here's the thing I really want you to hear. That number has been climbing since January. We started the year at 724,000 and we are sitting at 747,800 now. So yes, it is below where we were a year ago, but it has been quietly trending upward month over month through the spring. Detached inventory is sitting at 2,916 units with months of supply at just 2.45, which is still a relatively tight number in balanced market context. The sales to new listing ratio for detached is 54%, meaning that out of every 100 new detached listings that come to the market in a given month, roughly 54% of them are selling. That is how we measure demand against supply, and anything above 50% signals conditions that are reasonably competitive. Year to date, detached sales are down 4%. This is the part of the market that is still performing. I know I have said this before and I feel like a broken record, but this reality still holds. Well-priced, well-presented detached homes in desirable communities are moving. The market is not rejecting these homes. It is just no longer tolerating pricing mistakes the way it did when every property, or mostly every property, was getting multiple offers regardless of condition. Now moving on to semi-detached homes or duplexes. Those are sitting at a benchmark price of $691,100, down 1% year over year. Months of supply at 2.73, sales to new listings at 58%, relatively balanced, still moving. Year to date, duplexes are down only 4% on sales, which is modest. And townhouses are 422,300, down 6.4% year over year. Months of supply is at 3.35 and sales to new listing at 50%. Still in balanced territory, but there is more supply pressure for the townhouse sector than we are seeing with detached or duplexes. And the year-over-year price softness reflects that. Now onto apartments. This is where the market has the most pressure right now. And I want to be completely transparent about this. The apartment benchmark price in May was $300,400, which is down 9.1% year over year. Months of supply is at 5.14, which is elevated. The sales to new listing ratio is 42%. New listings are down 22%, but sales were down 30%. So even with fewer listings coming on, the net effect is still more supply pressure building. Year to date, apartment sales are down 28%. The reason for this is not a mystery. We built an enormous amount of new rental and apartment supply over the last 2 years, and that supply is now competing directly with the resale condo market. That extra supply is actually helping renters because rent inflation has come down to a 4-year low nationally. But for apartment investors and sellers, this is a tougher environment, and pricing needs to reflect the reality clearly. Krebs' chief economist flagged something this month that I think captures it perfectly. She noted that while the overall resale market has shifted to balanced, the supply pressure is having more noticeable impact on apartment-style units specifically, where conditions are increasingly favoring the buyer. And this is exactly what I'm seeing in the field. The variation across this city right now is significant. I have had detached homes in certain communities with real activity and competitive dynamics, and I have also seen apartment listings sitting with very little traffic. These are not the same market, and that brings me to the thing I want to spend a moment on, because it is the single biggest factor separating great outcomes from painful ones right now. The market has almost zero tolerance for pricing mistakes. I have seen it on both sides, representing sellers and bringing offers on behalf of buyers. A home that is priced right, presented well, and in the right community, it's moving, no matter the price point. Buyers are out there. I have been in conversation with clients this month where we have had real activity and genuine interest. And I have also seen great homes sit untouched, not because there's anything wrong with them, but because the price does not reflect what the market is willing to pay today. What something sold for 2 or 3 months ago is not a guarantee of what it will sell for today. The market shifts week by week, and if you have been sitting on the market for a while and your realtor gave you a price valuation at the time that you listed that was based on the data available at that moment in time, if months have passed and the market has moved, that original number may not reflect where you are today. And the sooner that reality is accepted, the better the outcome for everyone. I don't say that lightly. As a listing agent, I know this can be a difficult conversation. That is why I make it a priority to create a seller's report that my sellers receive anytime we are contemplating making a change to price and regularly throughout the listing period. That report pulls data from Realtor.ca and our MLS system, how the listing video is performing on YouTube and every social media platform that I am on, what is actively selling in your community, and who we're competing with. The goal is to have as much real current data as possible so that we can be proactive rather than reactive, because proactive can save you thousands of dollars in the long run. And I want to be clear, a home will sell for what the market is willing to pay in a given window of time, and for what a seller is willing to let that asset go for. Sometimes a property may be receiving interest at a price the seller is simply not ready to accept. And when a seller's expectations do not align with what the market is offering, sometimes no deals occur at all, and both parties have to walk away until one of them reserves the right to change their mind or find something else. Neither outcome is wrong, but having eyes on the data consistently means you are never making that decision with outdated information. Now, before we go further into the economics, I want to talk about timing, because this is arguably the most important thing I can tell you right now. We are in early June. Stampede is about a month away, and I honestly cannot wait to see what the data reflects once it's done, because every year Stampede marks a genuine turning point in this market. Activity begins to shift, but it is not just because everyone's at the party, going camping, heading to the parade, or doing more with their kids. It's because the serious buying and selling energy that has been driving the spring market starts to wind down. And the market we walk back into in September and late August is genuinely different than the one we're in right now. What this means for sellers is that if you are trying to capture this year's highest price, you want to be strategic about being on the market now, within this window. For buyers, if you're looking for bigger backyards, communities with great schools, yards you can actually use, those homes are most likely to be hitting the market right now, listed by people who have planned their moves strategically. And there's something to be said for seeing a property properly during the summer with the yard and the street showing at their best, rather than trying to imagine it under 2 feet of snow in February. Now, homes sell all year round. People's lives and circumstances do not wait for the calendar. But if you are being strategic, some of the best opportunities tend to be concentrated in this window that we're in right now. Okay, let's talk about what's happening at the national and provincial level, because it is very much shaping how people feel about making big financial decisions. And I want you to have the full picture, because if all you're doing is reading headlines, you're probably confused. And honestly, that confusion is pretty understandable. Here's the big one that dropped at the end of May. Canada has technically entered a recession. Statistics Canada confirmed that GDP slowed by 0.1% on an annualized basis in Q1 of 2026, following a 1% decline in Q4 of 2025. 2 consecutive negative quarters. By the common definition, that is a technical recession. Now, I want to be really thoughtful about how I frame this, because the word recession means a lot of different things, and the reality right now is more layered than the headline suggests. On a per capita basis, GDP actually edged up slightly in Q1, because our population also declined for the second consecutive quarter. And Stats Canada early estimate for April is pointing to a rebound of 0.4% growth, led by oil and gas, of course. So technically, 2 negative quarters. This is not the kind of broad consumer collapse most people picture when they hear that word. What it is a combination of factors that have been building for a while. Tariff uncertainty and the trade war with the US having hit manufacturing and exports. Business investment has been weak. In fact, Q1 was its 5th consecutive quarterly decline, And frankly, some of this is the result of years of federal policy decisions that have made it harder for businesses to invest and grow in this country. That conversation started under the previous government that has continued into the current one. What Canada really needed was a healthier, more organic economy, not one that was being propped up by rapid population growth that was artificially inflating our GDP numbers. That population boom is now slowing, which was necessary, but it also means the growth tailwind that had been relying on is no longer there to mask its underlying weaknesses. Where is this hitting the hardest? The markets that have been correcting for quite some time, like Toronto and Vancouver, who are feeling it most. Prices there have fallen roughly 20% from their 2022 peak, and the condo market in both of these cities is under significant stress. Here in Alberta and in Calgary specifically, we're seeing something different. Buyers are being more thoughtful, taking more time, and being more careful in their decision making. And that is rational given the environment. The buyers who have economic confidence and stable jobs are still acting. The ones sitting on the fence right now are largely doing so because of how the headlines feel, not necessarily because of what the fundamentals in this city actually support. And those fundamentals are genuinely different here. ATB Economics put it plainly. Alberta is faring far better than the rest of Canada. Our province posted GDP growth of 2.7% in 2025, outpacing the national economy for the fourth straight year. Alberta's employment year over year is up 3.5% compared to essentially flat for the rest of Canada. Retail spending in Alberta was up 5.5% in the first quarter, leading every single province at more than double the national average. And the affordability story is still real, even with everyone across Canada being more sensitive to cost of living right now. The average benchmark home in Alberta is still about $150,000 below the national average. Compared to Ontario, we're sitting about $234,000 lower. Compared to BC, we are $372,000 lower. That gap does not disappear overnight, and it's still one of the biggest reasons people are choosing to make the move to Calgary, even in a more cautious environment. Let's talk about jobs, because the Bank of Canada's own financial stability report released at the end of May identified the labor market as the primary risk to households right now, not interest rate, jobs. Canada lost 18,000 positions in April, and unemployment rose to 6.9%, the highest since last October. Youth unemployment is at 14.3% nationally. Here in Calgary, the unemployment rate was 6.7%, still elevated but better than the national number, and better than Edmonton's 7.1%. This is a very different conversation than what was dominating housing discussions 2 or 3 years ago, when rate hikes were the main concern. Right now, the conversation is about job security and economic confidence, and Alberta, with its energy sector and labor market strength, is in a better position to weather that than almost anywhere else in the country. Now let's talk about interest rates, because I know this is the question I get asked every single week. The Bank of Canada held the overnight rate at 2.25% on April 29th, the third consecutive hold this year. The next announcement is June 10th, which is after I'm recording this. And based on everything that happened in May, the GDP data, the soft job numbers, the fact that core inflation is still cooperating at around 2%, most economists are in the camp that the Bank of Canada will hold the overnight lending rate again. The rate hike talk that was circulating earlier this spring that I talked about in my last video quieted significantly after that recession data came out. One economist said it well. The soft first quarter should really throw a wet blanket over rate hike talk, because the economy is simply not in a position to absorb higher rates right now. That said, I want to be straight with you. There is still a scenario where rates move up if the conflict in Iran continues. If the disruption in the Strait of Hormuz is prolonged, and if those energy prices start feeding more broadly into the cost of everything, not just gasoline, the bank has been very clear that they will act. It is all about whether this spike stays contained or becomes generalized. What I tell my clients is this: nobody knows for certain where rates are heading, and anyone who says they do is guessing. And what we do know is that 2.25% is already a long way from where we were at the peak. And the bank's own data shows that more than 90% of people who renewed their mortgages over the past year renewed at rates below their original stress test rate. This is genuinely good news that is not getting nearly enough attention in the headlines. Let's talk about inflation quickly, because this one is a bit of a head scratcher. If you only look at the headline number, inflation jumped to 2.8% nationally in April, the highest in nearly 2 years. Alberta came in at 3.2%. But here's what actually drove that. Gasoline prices were up 29% year over year in April because of the war in Iran and the blockade of the Strait of Hormuz. This is the whole story. Strip out gasoline and the CPI only rose 2%. Core inflation, the measures the Bank of Canada uses to set policy, eased to their lowest level since 2021. Rent inflation came down to a 4-year low, and mortgage interest costs fell year over year for the first time since 2022. So you are feeling it at the pump, absolutely, and especially with food. But the underlying picture is more under control than the headline number makes it look. And the Bank of Canada said as much when the data came out. I want to spend a minute or so on Alberta's long-term energy picture because it is one of the most important stories for Calgary real estate demand over the next decade. In May, the Alberta-Ottawa Energy MOU reached a significant milestone. The two parties agreed on the industrial carbon price trajectory, and Ottawa committed to giving the West Coast Pipeline the status of a project of national interest, with a target of formalizing that by October 1st of this year. ATB Economics has modeled the economic impact and estimates that the combination of the Pathway project and the West Coast pipeline capacity could add on average over 5% to Alberta's GDP between 2027 and 2035, 5%. That means more jobs. That means people moving here. That means housing demand. Trans Mountain is already moving an additional 300 to 400,000 barrels per day to Asian markets, and that is already showing up in our export numbers. This is the kind of long-term structural story that makes Calgary real estate a fundamentally different investment than what you're looking at in a lot of other Canadian cities right now, and makes investing in Calgary for the long run still a very strong option. I sincerely hope that this project comes to life and that no red tape gets in the way, because the upside for this province and this city and Canada as a whole is real. On the tourism front, and this is something I always love to speak about because it speaks to where this city is headed. Alberta saw a 23% jump in visitors from overseas last year, far outpacing the national average of 6.6%, driven in large part by expanded direct air access into Calgary. That momentum has carried into 2026, with international visitor numbers staying near record highs, even as the rest of Canada is below pre-pandemic benchmarks. Restaurants and bar sales in Alberta were up 8.5% year over year in Q1, second strongest in the country. The visitor economy reached record high last year, and Travel Alberta is projecting continued growth through 2026. And with Stampede just about a month away, I cannot wait to see what the data shows on the other side of it. One contributing factor that is a bit ironic is that Canadians are skipping on U.S. strips because of trade tensions or political opinions, and a lot of those travel dollars are staying right here in Alberta, Banff, Jasper, etc. For a city that is increasingly competing on the world stage, That kind of momentum is significant, not just for hospitality workers, but for everyone who has invested in this city. At Calgary's Finest, we're built for exactly the kind of market we're in right now, because precision matters more in a balanced market than it ever did in a frenzy. We include wow effect staging with every listing. The full staging package stays in place for up to a month while we're on the market, because how the home shows matters more right now than it did when everything was selling in a weekend. And honestly, even during that market, it was still part of our professional standards to include it, along with professional listing videos, because we believe that every seller deserves that level of presentation. Our marketing reaches buyers through SEO, AI searchability, Globe and Mail campaigns, and RE/MAX Leaders in Luxury platform for upper tier properties. And I want to share something because I think it speaks to what's possible even in this trickier environment. Calgary's Finest is proud to be projected to close almost $13 million in real estate already secured in the month of June, all while I'm expecting my third kid. The market rewards preparation and execution, and that is what we bring to every single buyer or seller that we work with. If you're curious what your home is worth right now or want to understand where the opportunities are on the buying side, please reach out. That conversation is always free, and I would rather you have the right information early than be making decisions based on numbers that no longer reflect reality. I will wrap up with this. Canada may technically be in a recession. Rates are on hold with uncertainty in both directions. The national job market is soft, but Alberta is still the strongest economy in the country. Calgary is still the most affordable major city with this level of economic activity and this much momentum behind it. The housing market here is not collapsing, it's normalizing. It is asking more of sellers and giving more choice to buyers. And I genuinely believe that is healthy. I would much rather be here in this balanced market than watching what is happening in other cities on either extremes. The homes that are priced right, shown properly, and marketed well are still selling. The gap between a great outcome and a disappointing one right now comes down almost entirely to strategy, execution, and pricing. If this was helpful, please like, subscribe, and share it with someone who is trying to make sense of the market right now. There's a lot of noise out there, and I want the people in your circle to have access to what is actually happening. Drop a comment below and tell me, was it the cost of living that brought you to Calgary, or was it something else? I read every single one. Until next month, I'll see you then.